So how much money do you need to buy a home? Well, the answer is it depends. What's up, guys? Welcome back to my channel, Mortgages with Mike D. If you're new to the channel, I'm a licensed mortgage advisor, and the goal of the channel is just to help everyone out there, whether you're looking to buy a home or already a homeowner, just better understand the process when it comes to the mortgage aspect of things, and really everything real estate with a more heavily focus on the financing piece of it. In today's video, we're going to talk about how much money you actually need to purchase a home. Now, I say need because I think there's a big difference between how much the transaction will actually require itself versus how much money you should actually have set aside. I'll explain this a little more later. And for the purpose of this video, we're only going to be talking about primary residences. Again, you don't have to be a first-time home buyer. You can very well be a repeat buyer. All this information will still apply to you. So without any further ado, let's dive into today's video. So there are really two main components in determining how much money you will actually need to buy a home, plus like a subcategory, which I'll explain really quick. So the main two components are your down payment and your closing costs, which a lot of people forget about. And the kind of subcomponent is your market. And I think it's an important note because your market and the prices of homes in your specific area will dictate how much your down payment is, as well as what kind of closing costs you'll be subject to. But we'll talk about your down payment and your closing costs in greater detail coming up next. Based on your specific loan program, situation, your down payment and closing costs will vary. But let's kind of give you a general idea and understanding. That way you can know what to expect when you start beginning to look for your next home. Let's start with the down payment component. So down payments, like I said, will vary on the specific type of loan. Let's start with probably the most common type of loan you may even be familiar with, which is conventional financing. With conventional financing, the minimum required down payment is as little as 3%. Now, there is a quick caveat. You will have to meet certain income requirements set by Fannie Mae and Freddie Mac. If you meet those income requirements, great, you will be subject to a 3% down payment. Well, what if you don't? If you exceed or make too much money set by the income limits, you will then be subject to a minimum down payment of 5%. Now, with conventional financing, we see, like I said, 3%, we see 5%, 10%, 15%, and even 20% down, and sometimes more depending on the situation. There's reasons for this other than some people just have more money saved. So the more money you put down, you might be subject to lower interest rates, just better overall terms. And also, one obvious thing is the more money you put down, the smaller your loan will be. Therefore, the less your monthly payment will be. Now, you might have heard a lot about, the standard being 20% or you need 20% down, which is a myth. What the 20% down refers to is you will not be subject to PMI, which stands for private mortgage insurance. So if you're putting at least 20% down, you do not have that additional monthly expense baked into your monthly mortgage payment, which is the PMI. And not to go into too much detail, but PMI is essentially an insurance policy that your lender takes out to protect themselves, right? It's for the sole benefit of them. The idea is if you're putting less than 20% down, let's say 3 or 5%, you have less skin in the game, right? So in an effort to hedge their bet and to protect themselves, they want to make sure that, they have this, insurance policy in place to protect themselves should you ever go default. Now, before we go into the next loan program, remember, as just a quick reminder, we haven't covered closing costs yet. So those are the minimum down payment requirements for conventional financing. Next, we have FHA. An FHA loan is backed by the government and it stands for Federal Housing Administration. The minimum down payment for an FHA loan is 3.5%. FHA loans are very common for first-time home buyers, although you don't have to necessarily be a first-time buyer. You can very well be a repeat buyer and be eligible and qualify for FHA financing. I don't want to go into too much detail about the ins and outs and pros and cons of FHA loans or really any of these loans that we're going to cover because it'll just make the video way too long. The purpose, again, of today's video is just to cover your expected out-of-pocket cost. We also have VA loans. VA is another government loan that is backed by the Department of Veteran Affairs. That's where the VA comes from. These loans are designed for veterans, service members, and surviving spouses. The minimum down payment for a VA loan is 0%. The next loan we're going to quickly cover are USDA loans. These loans are covered by the U.S. Department of Agriculture. And the down payment requirement for this type of loan is, again, a whopping 0%. Now, like everything else, there are some quick caveats that are worth noting. There are stricter income requirements that are put in place in order for you to be eligible, but they're also property specific. So these properties have to be in a designated location identified by USDA that they deem that are rural. So again, you have to meet certain strict income requirements and the property has to be in a certain location for you to even be eligible for a USDA loan. Now, there are a lot of other loans out there. We can make this video go on forever, but I don't want to, like I said, go into too much detail about any of these specific loans, or do I want to cover every possible loan that exists in the marketplace, because I think that would just be overkill and would not serve the benefit of this video, which is just to go over the expected out of pocket when buying your first or next home. So now that we covered the down payment portion for each specific type of loan, remember, we still have to account for your closing costs. So what are closing costs? Without going into, again, too much detail, closing costs are basically fees that are charged and assessed by each party that is involved in the real estate transaction. I'll give you a couple of examples of what your closing costs might look like. You'll have some lender fees pertaining to applying and finalizing your mortgage. You'll have a home appraisal. You'll have homeowners insurance. There's property taxes, transfer taxes, recording fees, an array of different title fees, so on and so forth. It's important to understand, though, that these fees are generally pretty standard. Now, there are some, I'm sure, lenders and title companies, insurance companies that are going to be more expensive or more cheaper than one another. So I always suggest, and I think it's always worth it to, maybe at least get a second opinion. But just know, all in all, these fees are really going to be in alignment from, one lender or one title company to another. Okay, great. So I just rattled off a ton of different fees that are going to be dedicated for closing costs. So you're probably thinking, well, how much are these closing costs? So really quick, it will depend on, what state or even specific city you're looking to buy. That will have a pretty big influence on the estimated closing costs. So I'm in the state of Pennsylvania, and a good rule of thumb is anywhere between 4 and 6% of the sales price is a good indicator of what your estimated closing cost might be. You can also get a pretty good idea. I mean, good old Google will be pretty informative, right? So you can type in a specific area where you're thinking about buying your next home, and Google should give you a pretty good idea based on the area, state, or city that you're looking to buy a home in, of what the rough estimate for those closing costs might be on average. So let's run through a quick example of a hypothetical home, and let's come down to how much money you're going to need out of pocket. So let's say you're buying a home and the purchase price is $200,000. You might be thinking, well, good luck trying to find a house that's priced $200,000 in today's market. You might be right, but it's just an example, and the math will still apply whether it's $100,000 or $500,000. So home is listed for $200,000, and let's say that you meet the income requirement for conventional financing and you can put as little as 3% down. So 3% for your down payment will equate to $6,000 for the down payment. And now your closing cost, I like to be a little conservative, so let's assume the high end, which is 6%. So closing cost being 6%, that would equate to another $12,000. 6,000 plus 12,000. Now your estimated out of pocket for this $200,000 house is $18,000. Now remember in the beginning of the video, I said how much you need to buy a home. Now, again, in this example, we came up with $18,000. I would, again, to be conservative, just say I'm going to need around $20,000 at least. That way, you're not trying to find loose change under your couch cushions. It's better to be safe than sorry, and the more you have saved, the better off you'll be and the less stress that you'll have. Additionally, I mainly also say this because you don't want to be in a situation where you're draining and liquidating your entire savings, right? Obviously, the goal is to buy a home, and we know how great and important home ownership is. But if you're doing so at the expense of liquidating your entire savings, that's probably not a good idea. Let's be honest, life happens and things are going to come up not exactly as we might have planned or hoped for. So I always strongly recommend having some additional funds and savings and reserves in the event of a rainy day, right? I mean, just think about it. You just went through a process of buying your home, maybe your first home or a repeat home. And the process can be pretty stressful sometimes and overwhelming. So the last thing you want is to spend every last, dollar getting into that home and for something to go wrong, and your stress level will literally be through the roof, no pun intended. But having that, additional reserves funds set aside in the event something does happen, or you never know, you might just need it, will just eliminate so much stress and headaches, for the lack of a better word. So I strongly advise to have some money set aside for reserves. Everyone has their own opinion. 3 to 6 to 12 months of whatever that housing payment is set aside to to keep you afloat for however long you need that assistance for. Now, to bring things all together, and I cannot stress this point enough, it's so important to work with a knowledgeable mortgage advisor as well as a real estate agent. And if you can find both of them that are local, I recommend that as well, because they're going to be more in tune with your specific market that you're looking to buy the home in. Things like credit score, income, assets, so on and so forth will dictate what mortgage products you'll be eligible for, and having that knowledgeable mortgage advisor by your side, holding your hand every step of the way, can save you tons of money in the long run, right? And like I said, it can very well be a stressful process. So you want someone that is going to help you every step of the way and help guide you toward what loan program, not only that you're eligible for, because you might be eligible 1, 2, or 3 different products, but they're also going to say, okay, here are some different scenarios, here are some different proposals, here are the pros and cons of each. So you're still making a decision, but they're kind of guiding you to let you know which one might be financially wise and why. And in terms of your real estate agent, not only will they ensure that you're not overpaying for something, but they're also going to help you strategically structure your offer to help you stand out and ultimately win the deal. In the end, everyone's situation is unique, so it's imperative to have a conversation and discuss all of your options with your mortgage loan advisor ahead of time, just so you're fully informed, you know what to expect, you're prepared and ready to go for when the time comes. And that's it. Now you know how much money to expect when buying a home. Make sure you don't forget about those closing costs, because a lot of people do. A lot of people just say, what's my down payment? How much money do I need down? Although that's an important component, you can't lose sight, and you definitely cannot forget to account for closing costs, and always round up if you can. I rather say I need 20 and then really need 18 instead of saying I need 18 but then really need 20,000, right? So be conservative, talk with the local experts, and control what you can control, and you'll be well on your way to either buying your first home or your next home. I hope you enjoyed today's video. If you found any value, learned anything new, please give me a like, subscribe to the channel. It would mean a lot. and we'll see you on the next one. Thanks for watching.